Guys, I absolutely love this problem. It shows the magnitude of what happens when you take a relatively minor amount of money and you capitalize it instead of expensing it. Now, companies all over the U.S. have been caught doing this. One of the big ones was WorldCom right here in Clinton, Mississippi, where Mississippi College is. And WorldCom was our first uh, Fortune 500 company that was in Mississippi, and it basically manipulated its books by taking things that were supposed to be expensed and capitalizing them instead. So this is a problem, kind of shows the magnitude of that and how and why that is so pervasive to both the financial statements and the analysis of the financial statements. If you look here, guys, a repair cost that was $40,000 was capitalized in error. So that means that we didn't record it as an expense. So that means that our income was $40,000 less, if you would, if we had used that 40,000 as an expense, the whole thing. But what we did instead was we capitalized it, and we had 8 years on it. So we were depreciating at 5,000 a year if you look at straight line depreciation. Now, in order, after the current year is kind of up, you got to correct this error. So you can just take the operating income that was originally reported, which was 225,000, and they give us this, right? And then we have to take into account that that expense would have decreased your income. So we use that to decrease, but we got to remember, guys, that we did depreciate. So we did expense some of this appropriately, right? But we had to add that back because we don't want to take both the error and the error of depreciation. We have to fix both of them, if you will. Okay. So now we have a corrected operating income of 190. And then B asks you about the return on investment for the current year based on the original data. Now this is before you made the correction. So I want you to look here. I put operating income that you started with here. I put that in red, okay? And then your average total assets then here, you'll see assets are 1,600,000 are calculated here to get a return on investment of 15%. So then we have to, in order to fix this, we're going to have to not only fix operating income, but also average total assets. So let's take our assets and make an adjustment to them. See, 1,600,000, and then we're going to add that cost, and we're going to subtract out that to make the change in total assets be that $35,000 change. So we really had assets then of 1,565,000 instead of the 1,600,000. So look what happens to return on investment calculations. This is real interesting. What happens is we have operating income divided by total number of assets. Here's 190, and then your average total assets is different. So look, we have 12.8% then for our return on investment. 12.8%. So this is a huge difference, guys, between 15% return on investment and 12.8. So and this was only 40,000, excuse me, up against 1,600,000, like $1,600,000 worth of assets. So you can see the magnitude of how this happens, and how if a company has an incentive, right, to capitalize when they should be expensing. So that's why we're so particular in American GAAP by making sure that we are recording expenses that are generally accepted, because if some of us are capitalizing and some of us are expensing, then we don't have comparable financial statements among industry, and then we don't have understandable financial statements for the investor. So we clearly we're looking for that. But anyway, I just thought I would go over that problem with you and let you kind of understand the magnitude of capitalizing something when you should be expensing it is huge. It's huge. It affects not only your financial statement numbers, but also the analysis of them.